Thank you, Dave. Thanks for doing this again. Greetings, everyone. So I've been trading for 52 years. You should listen to me. I will not bullshit you. The bottom line is this. I have traded tens and thousands of times. I've been all over the world teaching people how to trade. I'm a real trader. I trade practically every day. I've learned a lot about trading, learned a lot about myself, learned a lot about people. I've learned a lot about traders. Many traders will tell you they want to make money, but their behavior shows you otherwise. It's not about what people say, it's what about people do. Very, very simple. The vast majority of traders, excluding, of course, everyone here today, the vast majority of traders don't want to make money because they don't act like they want to make money. And even though they know what they should do, they don't do it. So I'm not going to bore you with my credentials. You can see them all here. I'm not going to read to you. I will give you a guarantee. I guarantee you that you will get more than your money's worth today. And since you paid nothing to be here today, you will get more than nothing. The good news is I have some real pearls of wisdom to show you. The bad news is the vast majority of you won't believe me, although there are some of you who've seen my work before, who are true devotees of my work and who should be making money. If you're using my methods and you're not making money, there's a problem and we have to talk. Actually, we don't have to talk. You can just go on your merry way, but I will talk to you if you want to. So everything we do in the market's about patterns. Patterns, patterns, patterns. You've probably seen a lot of patterns here today. The speaker before me, Mr. Smith, showed a bunch of patterns. The good news about patterns is there are thousands of them. Every trader's got their favorite little pattern. The bad news about it is that most of them are totally worthless. They don't work. They're absolute rubbish, and they will never work. Now, mind you, I'm not naming specific patterns that have been taught here today. I'm just talking in general. A good 95% of patterns look good on paper. They look good in theory. It's like the concept of marriage. It sounds good on paper, but in theory, it's tough to make it work. So today I'm going to show you some patterns that work extremely well. One in particular, and we're going to start out with a seasonal pattern. But let me say this about patterns. The good news about patterns is, as I said, we can find ways to make them work. We can find statistics. The bottom line is this. You have to see the pattern and you have to have specifics about the pattern. In other words, I can't look at a chart and say, the market looks like it wants to go up. What the hell does that mean? How does the market know what it wants to do? And what looks like something to you might look like something entirely different to me. So everything I do must be completely objective. So everything I do falls into a structure. If you don't have a structure for what you do, you've got nothing. The structure consists of three things for me: setup, trigger, and follow through. A setup is a pattern. We go to the computer, we find patterns that work. What does that mean? It means patterns that predict the future, that have predictive validity, that are algorithmic, rule-based, clear, specific, not subject to interpretation. You know, here's the thing that's so amazing. Today, in this modern world, everybody and their brother wants things to be fast. Faster internet, faster food, faster service, faster delivery. Overnight delivery wasn't good enough. Now they want instant delivery by drone. Faster speeds for your internet, faster trades, faster options. Faster is good and it's fun. But the big money is made in the big move, and the big move happens over time. So even though I've written the 4 best-selling books from McGraw-Hill on day trading, I don't like day trading. It's hard work. Many of my trades end up being day trades, but I don't go into a trade with the specific idea that it's going to be a day trade because As I say, I want to work smart. I don't want to work hard. So if you think I'm going to talk about day trading, it's not going to happen. If you think I'm going to talk about options, it's not going to happen. I'll show you things that are much better. So we need to find patterns that are algorithmic, rules-based. We need those patterns to trigger. In other words, it's one thing to say that a pattern's happened 75% of the time in the last 50 years. What's going to happen this time? I want to whittle down that 25% of the time that is going to be wrong and turn it down to maybe 10% of the time wrong. And I do that with a trigger. The third part of the equation is follow through. I need to follow through. I need to know when I'm going to be wrong. I need to be able to identify a bad trade once it happens. I need to be able to identify a good trade with the target. But here's the most important thing that most people will never do. I need to make that small trade into a big trade by managing that profit and maximizing it. Most people are happy to just take a trade and take their $300 or $400 at the end of the day and go home. That's not the way it's done. You need the big moves. So today's going to be about the big moves. So if you look at stuff like this, the golden cross, the death cross, opinions, the facts, we want facts, not opinions. We want specifics. We want track records. We want performance. We want rules. We want algorithms. We want everything that's completely clear. If something is not clear to you, you're going to interpret it. If you're going to interpret it, you will probably be wrong. And those few times that you'll be right, you won't learn anything. So I've got a list over here of about, 19 things. If you want the PowerPoint presentation, just send me an email. I'll send it to you, no charge. I respectfully submit to you this. If you don't know the answer to all of these questions before you make a trade, you are not trading the right way. You want to know when to get in, when to get out, what to buy, what to sell, odds of success, average profit, average loss, profit to loss ratio, blah, 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 blah. And again, I say to you, I didn't come by these rules by pulling them out of my you-know-what. I came by these rules through experience, through trading, through real money, through real research, trade after trade after trade. So I give you these pearls of wisdom. Sadly, I know most people won't use them, but hey, I've done my job. Let's go. Let me get rid of this stupid thing. One moment, please. Let's go to the next slide. So you can have these and do them. So look, people say, what are the facts about the stock market right now? If we take every year of the Dow Jones back to 1950, and you make one chart that shows what happens in the typical year, it's this chart right here. Here's where we are right now. So people say, why is the market going down? The market's going down because this is the most critical downtime of the entire year, which is followed by the most predictable bull market of the entire year right over here. If I look at this chart, I can tell you what percentage of the time stocks go up or down during each week of the year. And I can use that information by fine-tuning it with a computer and finding trades like this. Example, 76% of the time going short the December S&P, end of day September 20th, getting out end of day September 25th has been right 76% of the time in the last 50 years. I know my average profit, my average loss, my stop, my maximum upswing, my max consecutive losses, and so forth. So this, in my opinion, and in my experience, this is how to trade. This is how to make money. You're not going to make money by looking at a chart and figuring it looks like it's got support, it looks like it's got resistance. That's a lot of BS. In fact, let me show you this. And have you heard of that expression, pearls before swine? Think about what it means. Here's the trade that for 70 years, I'm talking 70 years, has been right 90% of the time. What? What did I say? Buying the Dow Jones or equivalent. End of day October 27th, getting out January 14th, risking 12%, close only stop has been right 90% of the time. This, ladies and gentlemen, is a trade. this is a specific trade. But guess what? Most traders can't hold a trade from October 27th to January 14th unless it's a losing trade. That's right. People love to get out of their winners really fast, and they like to keep their losers till they grow hair on them. Are you that kind of trader? So here's my track record for this trade. Here is the history right over here, year by year by year. Here is the results, one year after the other for 71 years, year after year. And here's the complete performance cumulative graph. So what's wrong with this trade? Nothing. Everything's right with this trade. Is it 100%? Of course not. So here's what's going to happen with this trade. People will look at this trade and they'll say, well, it's looking too good. It's gone parabolic this time. And we know that parabolic moves don't last. Or they're going to say, it can't possibly work this year because of COVID. What was the excuse last year? It can't possibly work because of Trump. So there's going to be an excuse. It's not about the excuse. It's about mitigating the risk. If you can't afford 12% move against you, trade a smaller position, trade an option, trade an ETF, do something. No, it's not going to work every year. So let's go forward. How about this? I have a chart, and just like they do with some pictures in the past, they blot out the eye so you can't see the participant. I blocked out the name of the market. Why? Because people have natural prejudices against market, and they say, it's going to go up, it's got to go up, gold's got to go up sometime, it just has to go up. Forget about that. I have this chart. As you can see, it's a long-term chart, goes all the way back to 1983 through 2020, and call it Market X. On this chart, I've got some markings. I've got some green areas with some red arrows. I want you to look at these. So I'll help you with this in case you're visually impaired. Here's the bottom, here's the green. Here's the bottom, here's the green. Here's the bottom, here's the green. Bottom, green, bottom, green, bottom, green, etc., etc., etc. So looking at the chart, if we were to do a tally, you would see that in virtually every one of these major bottoms, the indicator has turned green. Well, isn't that amazing? And by the way, these have not been small moves. These have been huge moves. So what's this green thing? It seems that this green thing has always been right. It's been ahead of the curve. It's gotten in before the move started. And then after the move starts, it just floats and coasts and rests on its profit. Very cool. How about this one here? Sugar. Sugar futures. Green, 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 green. And then a move of 111% in futures. And since there's an ETF for sugar, SGG, the 68% move in sugar ETF at the same time. So what is this green? So here you go. Oh, how about this? One of the biggest moves over the shortest period of time in silver. Look what happens before this huge up move. The indicator turns green. What the hell is that green thing? And what about this one? It comes from the COT report. The COT report, Commitment of Traders report, available free of charge from the US government. Depending on your charting service, there may be a charge to have it plotted on your screen. There may be a small charge, or they may not have it at all. But the COT report is probably the most valuable piece of insider information that you can get. What does it say? What does it do? What does it tell us? The Commitment of Traders report comes out every week and tells us what percentage of futures contracts are held by every one of three different groups of traders: commercials, small speculators, and large speculators. So basically what it says is this, to give you an example. Let's say there's 1 million contracts of S&P futures that are available. Let's say that 500,000 of those are short, and half a million of those are long. It means the commitment of traders for this group of traders is break even. No one side is showing a preference. It's a completely even Steven market. But let's say that the report comes out and it shows that 80% of the contracts by commercials are held on the long side and 20% are held on the short side. What does it mean? It means that commercials are bullish. They're buying for a big move. The important thing about this report is this. We need to know exactly which group to follow. Do we want to follow what the small trader is doing? Do we want to follow what the big trader is doing? Do we want to follow what the commercial is doing? I say this. You always want to know what the commercial is doing. What is the commercial? Commercials are the biggest and best traders in the world. In fact, they're not even traders. They're individuals or enterprises that are in the business of using the stuff. So example, if I go to this chart back here, let me go back there for just a moment. Here we go. Let's talk about silver. On this particular point, the balance was to the long side. In other words, more commercial traders were long silver than short silver. They were taking delivery of contracts. Why? Because they expected prices to go up. What led them to expect prices to go up? They know their business. They know demand. They're end users of silver, jewelry companies, and silver miners. So they know the demand side of the equation and they know they need more silver. If they can't get more silver out of the silver mine, they've got to buy the futures and take delivery, which is the purpose of the futures market to begin with. And of course, there are ETFs for silver as well. So the bottom line is, no puns intended, you need to know who to follow. I don't follow the small traders. I don't follow the big speculators. I follow the commercials. We look at what the small trader is doing using a different index. I'll tell you about that later. Let's take a look at a couple of examples, and I think you'll understand this better. So here we go. I'm going to skip through these and show a chart. Let's talk about this market. Cocoa. There's an ETF for cocoa, NIB. I want you to look at the chart. So before this big move up, commercials were buying. Before this big move up, commercials were buying. Before this huge move up, commercials were buying. And before this move up here, commercials were buying. Commercials buy in advance. They buy on a scale down. They dollar cost average. So we want to know what the commercials are doing. Commercials represent the biggest companies in the world. Example, commercials in the soybean business, Archer Daniels Midland, Bunge Grain, the Andersons, and so forth. Commercials in the banking business, the large banks. Commercials in the copper business, copper miners, end users, automobile manufacturers, and so forth. These are the people, the individuals, the enterprises that make the market what it is. So let's go to this chart right over here. There's another no-name chart. Doesn't matter what it is, but I want you to see what happens. All the way down, commercials are acquiring positions. When as soon as the market starts to move up, they unload their positions, they get out. They've made their big money. How about this one right over here? Another example. Commercials buy. The market turns higher and it goes up and commercials begin to unload their positions. Very important point of information. This legal insider information is available to anyone who wants it, but within the context of what I told you, it is not a trigger, it's a setup. I'm always looking for setups for big moves. And once I have that setup, I need a trigger. So the commercial information is just the first part of the equation. Let me find another chart for you. Just bear with me for a moment. We'll go forward a little bit because I don't want to run out of time. Okay, check this out. Here is the NASDAQ, the mini NASDAQ. This is a daily chart. Prior to this big up move, what were commercials doing? They were buying. What were they doing here? They were buying. And what have they been doing for many, many weeks now? They've been buying since February of this year. Every week, they're net long. Why? They're net long because they expect to move up. It's really, really simple. But there's a dilemma here. This information at the bottom of the chart shows small trader sentiment. The small trader who's most apt to lose their money. I want to show you something. When sentiment is way up to the top over here, it correlates with the top in the market. When sentiment is way here at the bottom, it correlates with the bottom of the market because the small trader is usually most bearish at the bottom and most bullish at the top. What's been happening now? Not only have commercials been buying every week, every day, but the small trader's been buying too. That's an abnormal situation. Something's got to give. What's going to give? The small trader is going to be shaken up by a sell-off, and the big trader, the commercial, is going to be buying into that sell-off. And that's already starting to happen. But that's neither here nor there. That's just a setup we need to trigger. How about this? Have you been watching the Nikkei? The Nikkei for the last several days has made huge moves up. What preceded those huge moves? All of this commercial buying, week after week after week after day. How about this one right over here? The Russell. As you can see, the Russell's been going basically sideways for weeks and weeks and weeks. What's the commercial been doing? They've been steadily, slowly, but surely accumulating positions, adding and adding to their long positions. Dave, how much time do I have left?
17 minutes.
Thank you very much. So let me go through this one here. Let's talk about Bitcoin. I'm not a big fan of Bitcoin. I don't believe you can create something out of nothing, but hey, it's a market. If it's a market, I'll trade it as long as there's liquidity. What happened to Bitcoin? Check it out. It's a weekly chart of Bitcoin futures. Before this huge move in Bitcoin, commercials started to buy. They bought more over here, and they've been buying steadily through this entire move. And they've been right. So by following what the commercials have been doing, in other words, the major trend of the market, you've been right. But remember, this is the first step. But let's go to the next step that you might find interesting. Here we go. Check it out. This was the Bitcoin chart as of the end of the week just ended, as of the end of last week. In my report, which I put out once a week, I indicated something anomalous was happening. For the first time in many days, the commercials have stopped buying. Why? Let's first answer the question, why were they doing all this buying? Easy. Because you've had a proliferation of Bitcoin funds, companies that will take public money and invest it in Bitcoin for you so that you don't have to do the dirty work. So all of this money's been coming into these funds, and that money's just been sitting there. And then the managers of those funds have been saying, wait a minute, our customers are getting pissed off. They gave us money for Bitcoin, they see the market going crazy, and they want a piece of the action. Let's buy Bitcoin. So these large commercial traders have been buying Bitcoin. But for the last week or two, they stopped. And what happened to the market today? As I said in my report yesterday, over the weekend, that is, a $5,000 plus drop in Bitcoin today. And how did it happen? It happened because commercials stopped supporting the market. So that's one way in which to use this legal inside information. Let me show you a couple of more charts. Before this huge up move in the price of gold, commercial buying. This was the first commercial buying in gold in many years. Now, I want to make sure you understand me correctly. I'm not saying that commercials are not buying anything. I'm simply saying the balance shifted to the long side. Yes, there were commercials that are short. There are commercials that are hedged, but there were more commercials that were net long than there were net short. And that is what preceded this big up move in gold. The move that I showed you earlier in silver was the first time in the history of silver that commercials have been net long, and it preceded a huge move up. Let's look at another chart. Here's the silver chart again. How about platinum? And you'll notice commercials started buying before the move began. At the same time, the small trader was negative, and this is the ideal combination that we want to see. Let's go to another chart. The huge move that we've seen in copper over the last couple of years was preceded by this. Huge record net long positions in copper futures by commercials. And the reason I recommended buying COPX, FCX, BHP, SCCO, Rio Tinto, etc. was because we had a timing trigger. So going all the way back to the beginning of the presentation, everything here is a setup to go long, a setup to go long, a setup to go long. A setup needs a trigger, and there's a specific trigger that we use with a setup. Very, very simple. Let's go to the next chart. How about this? You trade coffee futures? If you trade coffee futures or the coffee ETF, here's a bunch of buying, here's the up move. Here's a bunch of buying by commercials, here's the up move. Here's a bunch of buying by commercials, the biggest buy we've seen in a long time, which preceded a huge move up in coffee futures. And again here, and here, and here. So my friends, I strongly suggest to you that you take a look at some of these moves using the Commitment Traders report. Now, there's other things we can do. We can do cycles. Here's, for example, a cycle in small trader sentiment showing the statistical analysis and projection of cycles as another form of patterns. So let me do this. One moment, please. How about this? The combination of a cycle and Commitment Traders commercials. What do we have here? Short-term euro-dollar interest rate futures equal to the Treasury note, Treasury bill, 91-day bill. A near perfect cycle of 1, 2, 3, 4, 5, 6 years, 5.5 years. And you'll notice commercial buying activity increases at the cyclical low, and here, and here. The largest commercial buying in the history of interest rate futures right over here and over here. So here's what you're looking for to review. You're looking for patterns that work. How do you find patterns that work? You test them on the computer. It's a marvelous invention. Number 2, you need to have some rules. Setup, trigger, and follow through. Number 3, seasonality is one of the best setups that you can have. Number 4, Commitment Traders report, legal insider information is absolutely golden in order to predict the big moves. So I'm done. If you want to write me, here's my email. If you want a copy of the PowerPoint, I'll be glad to send it to you, no charge. You can go to my website, or you can go to seasonaltrader.com to learn more about seasonals. I have had a good time. I hope you have too, and I hope most of all that I've taught you something and that you will use it to your benefit and send me a really nice letter saying, hey, Jake, you changed my life for the better. That will do it for me.